2. Learning objectives. After studying this chapter, you will be able to explain the concept of reconstitution of a partnership firm. Identify the matters that need adjustments in the books of firm when a new partner is admitted. Determine the new profit-sharing ratio and calculate the sacrificing ratio. Define goodwill and enumerate the factors that affect it. Explain the methods of valuation of goodwill. Describe how goodwill will be treated under different situations when a new partner is admitted. Make necessary adjustments for revaluation of assets and reassessment of liabilities. Make necessary adjustments for accumulated profits and losses. Determine the capital of each partner, if required according to the new profit-sharing ratio, and make necessary adjustments. Make necessary adjustments on change in the profit-sharing ratio among the existing partners. Partnership is an agreement between two or more persons, called partners, for sharing the profits of a business carried on by all or any of them acting for all. Any change in the existing agreement amounts to reconstitution of the partnership firm. This results in an end of the existing agreement and a new agreement comes into being with a changed relationship among the members of the partnership firm and/or their composition. However, the firm continues. The partners often resort to reconstitution of the firm in various ways, such as admission of a new partner, change in profit-sharing ratio, retirement of a partner, death or insolvency of a partner. In this chapter we shall have a brief idea about all these and in detail about the accounting implications of admission of a new partner or an on change in the profit-sharing ratio. 2.1 Modes of reconstitution of a partnership firm. Reconstitution of a partnership firm usually takes place in any of the following ways. Admission of a new partner. A new partner may be admitted when the firm needs additional capital or managerial help. According to the provisions of Partnership Act 1932, unless it is otherwise provided in the partnership deed, a new partner can be admitted only when the existing partners unanimously agree for it. For example, Hari and Haq are partners sharing profits in the ratio of. Reconstitution of a partnership firm, admission of a partner. Rationalized 2023-24 admission of a partner 49. 3:2. On April 1, 2017, they admitted John as a new partner with 1/6 share in profits of the firm. With this change, now there are 3 partners of the firm and it stands reconstituted. Change in the profit-sharing ratio among the existing partners. Sometimes the partners of a firm may decide to change their existing profit-sharing ratio. This may happen in account of a change in the existing partner's role in the firm. For example, Ram, Mohan and Sohan are partners in a firm sharing profits in the ratio of 3:2:1. With effect from April 1, 2017, they decided to share profits equally as Sohan brings in additional capital. This results in a change in the existing agreement leading to reconstitution of the firm. Retirement of an existing partner. It means withdrawal by a partner from the business of the firm, which may be due to his bad health, old age or change in business interests. In fact, a partner can retire any time if the partnership is at will. For example, Roy, Ravi and Rao are partners in the firm sharing profits in the ratio of 2:1. On account of illness, Ravi retired from the firm on March 31, 2017. This results in reconstitution of the firm now having only 2 partners. Death of a partner. Partnership may also stand reconstituted on death of a partner, if the remaining partners decide to continue the business of the firm as usual. For example, X, Y and Z are partners in a firm sharing profits in the ratio 3:2:1. X died on March 31, 2017. Y and Z decide to carry on the business, sharing future profits equally. The continuity of business by Y and Z sharing future profits equally leads to reconstitution of the firm. 2.2 Admission of a new partner. When firm requires additional capital or managerial help or both for the expansion of its business, a new partner may be admitted to supplement its existing resources. According to the Partnership Act 1932, a new partner can be admitted into the firm only with the consent of all the existing partners unless otherwise agreed upon. With the admission of a new partner, the partnership firm is reconstituted and a new agreement is entered into to carry on the business of the firm. A newly admitted partner acquires two main rights in the firm. 1. Right to share the assets of the partnership firm. And 2. Right to share the profits of the partnership firm. For the right to acquire share in the assets and profits of the partnership firm, the partner brings an agreed amount of capital either in cash or in kind. Moreover, in the case of an established firm which may be earning more profits than the normal rate of return on its capital, the new partner is required to contribute some additional amount known as premium or goodwill. This is done. Rationalized 2023-24-50 Accountancy, Not-for-Profit Organization and Partnership Accounts. Primarily to compensate the sacrificing partners for loss of their share in super profits of the firm. Following are the other important points which require attention at the time of admission of a new partner. 1. New profit sharing ratio. 2. Sacrificing ratio. 3. Valuation and adjustment of goodwill. 4. Revaluation of assets and reassessment of liabilities. 5. Distribution of accumulated profits, reserves. And 6. Adjustment of partners' capitals. 2.3 New profit sharing ratio. When new partner is admitted, he acquires his share in profits from the old partners. In other words, on the admission of a new partner, the old partners sacrifice a share of their profit in favor of the new partner. But, what will be the share of new partner and how he will acquire it from the existing partners is decided mutually among the old partners and the new partner. However, if nothing is specified as to how does the new partner acquire his share from the old partners, it may be assumed that he gets it from them in their profit-sharing ratio. In any case, on admission of a new partner, the profit-sharing ratio among the old partners will change, keeping in view their respective contribution to the profit-sharing ratio of the incoming partner. Hence, there is a need to ascertain the new profit-sharing ratio among all the partners. This depends upon how does the new partner acquires his share from the old partners, for which there are many possibilities. Let us understand it with the help of the following illustrations. Illustration 1. Anil and Vishal are partners sharing profits in the ratio of 3:2. They admitted Sumit as a new partner for 1/5 share in the future profits of the firm. Calculate new profit sharing ratio of Anil, Vishal and Sumit. Solution. Sumit's share 1/5, remaining share equals 1/15. 4/5. Anil's new share equals 3/5 of 4/5 equals 12/25. Vishal's new share equals 2/5. 4 equals 11/20. Sinha's new share equals 1/5. The new profit sharing ratio among Das, Sinha and Pal will be 11:4:5. 2.4 Sacrificing ratio. The ratio in which the old partners agree to sacrifice their share of profit in favor of the incoming partner is called sacrificing ratio. The sacrifice by a partner is equal to old share of profit, new share of profit. Rationalized 2023-24 Admission of a partner 53. As stated earlier, the new partner is required to compensate the old partners for their loss of share in the super profits of the firm, for which he brings in an additional amount as premium for goodwill. This amount is shared by the existing partners in the ratio in which they forego their shares in favor of the new partner, which is called sacrificing ratio. The ratio is normally clearly given as agreed among the partners, which could be the old ratio, equal sacrifice, or a specified ratio. The difficulty arises where the ratio in which the new partner acquires his share from the old partners is not specified. Instead, the new profit-sharing ratio is given. In such a situation, the sacrificing ratio is to be worked out by deducting each partner's new share from his old share. Look at the illustrations 6 to 8 and see how sacrificing ratio is calculated in such a situation. Illustration 6. Rohit and Mohit are partners in a firm sharing profits in the ratio of 5:3. They admit Bijoy as a new partner for 1/7 share in the profit. The new profit sharing ratio will be 4:2:1. Calculate the sacrificing ratio of Rohit and Mohit. Solution: Rohit's old share equals 5/8, Rohit's new share equals 4/7, Rohit's sacrifice equals 54/3. 8, 7, 5, 6. Mohit's old share equals 3/8, Mohit's new share equals 2/7, Mohit's sacrifice equals 32/5. 8, 7, 5, 6. Sacrificing ratio among Rohit and Mohit will be 3:5. Goodwill. Goodwill is also one of the special aspects of partnership accounts which requires adjustment, also valuation if not specified, at the time of reconstitution of a firm with a change in the profit-sharing ratio, the admission of a partner, or the retirement or death of a partner. 2.5.1 Meaning of goodwill. Over a period of time, a well-established business develops an advantage of good name, reputation and wide business connections. This helps the business to earn more profits as compared to a newly set up business. In accounting, the monetary value of such advantage is known as goodwill. It is as an intangible asset. In other words, goodwill is the value of the reputation of a firm in respect of the profits expected in future over and above the normal profits. It is generally observed that when a person pays for goodwill. Rationalized 2023-24-56 Accountancy, not-for-profit organization and partnership accounts. She pays for something, which places him in the position of being able to earn super profits as compared to the profit earned by other firms in the same industry. In simple words, goodwill can be defined as the present value of a firm's anticipated excess earnings, or as the capitalized value attached to the differential profit capacity of a business. Thus, goodwill exists only when the firm earns super profits. Any firm that earns normal profits or is incurring losses has no goodwill. 2.5.2 Factors affecting the value of goodwill. The main factors affecting the value of goodwill are as follows. 1. Nature of business. A firm that produces high value added products or having a stable demand is able to earn more profits and therefore has more goodwill. 2. Location. If the business is centrally located or is at a place having heavy customer traffic, the goodwill tends to be high. 3. Efficiency of management. A well-managed concern usually enjoys the advantage of high productivity and cost efficiency. This leads to higher profits and so the value of goodwill will also be high. 4. Market situation. The monopoly condition or limited competition enables the concern to earn high profits, which leads to higher value of goodwill. 5. Special advantages. The firm that enjoys special advantages like import licenses, low rate and assured supply of electricity, long-term contracts for supply of materials, well-known collaborators, patents, trademarks, etc. enjoy higher value of goodwill. 2.5.3 Need for valuation of goodwill. Normally, the need for valuation of goodwill arises at the time of sale of a business. But, in the context of a partnership firm, it may also arise in the following circumstances. 1. Change in the profit sharing ratio amongst the existing partners. 2. Admission of new partner. 3. Retirement of a partner. 4. Death of a partner. And 5. Dissolution of a firm involving sale of business as a going concern. 6. Amalgamation of partnership firms. 2.5.4 Methods of valuation of goodwill. Since goodwill is an intangible asset, it is very difficult to accurately calculate its value. Various methods have been advocated for the valuation of goodwill of a partnership firm. Goodwill calculated by one method may differ from the goodwill rationalized 2023-24 admission of a partner 57 calculated by another method. Hence, the method by which goodwill is to be calculated may be specifically decided between the existing partners and the incoming partner. The important methods of valuation of goodwill are as follows. 1. Average profits method. 2. Super profits method. 3. Capitalization method. 2.5.4.1 Average profits method. Under this method, the goodwill is valued at agreed number of years purchase of the average profits of the past few years. It is based on the assumption that a new business will not be able to earn any profits during the first few years of its operations. Hence, the person who purchases a running business must pay in the form of goodwill a sum which is equal to the profits he is likely to receive for the first few years. The goodwill, therefore, should be calculated by multiplying the past average profits by the number of years during which the anticipated profits are expected to accrue. For example, if the past average profits of a business works out at Rs. 20,000 and it is expected that such profits are likely to continue for another 3 years, the value of goodwill will be Rs. 60,000, Rs. 20,000 times 3. The above calculation of goodwill is based on the assumption that no change in the overall situation of profits is expected in the future. The above illustration is based on simple average. Sometimes, if there exists an increasing or decreasing trend, it is considered to be better to give a higher weightage to the profits to the recent years than those of the earlier years. Hence, it is advisable to work out weighted average based on specified weights like 1, 2, 3, 4 for respective year's profit. However, weighted average should be used only if specified. See illustrations 10 and 11. Illustration 10. The profits of firm for the 5 years are as follows. Year profit. Rs. 2012, 13, 20, 000, 2013, 14, 24, 000, 2014, 15, 30, 000, 2015, 16, 25, 000, 2016, 17, 18, 000. Calculate the value of goodwill on the basis of 3 years' purchase of weighted average profits based on weights 1, 2, 3, 4 and 5 respectively. Solution. Year ended the 31st of March. Profit weight product. Rs. 2012 13 20,001 20,000 2013 14 24,000 248,000 2014 15 30,000 3 90,000 2015 16 25,000 4 100,000 2016 17 18,000 5 90,000 15 348,000. Weighted average profit equals Rs. 348,000. 15 equals Rs. 23,200. Goodwill equals Rs. 23,200 times 3 equals Rs. 69,600. Rationalized 2023-24 admission of a partner 59. Five point 4.2 Super Profits Method. The basic assumption in the average profits, simple or weighted, method of calculating goodwill is that if a new business is set up, it will not be able to earn any profits during the first few years of its operations. Hence, the person who purchases an existing business has to pay in the form of goodwill a sum equal to the total profits he is likely to receive for the first few years. But it is contended that the buyer's real benefit does not lie in total profits. It is limited to such amounts of profits which are in excess of the normal return on capital employed in similar business. Therefore, it is desirable to value goodwill on the basis of the excess profits and not the actual profits. The excess of actual profits over the normal profits is termed as super profits. Normal profit equals firm's capital times normal rate of return. 100. Firm's capital includes partners' capital and reserves and surplus but excludes fictitious assets and goodwill. Suppose an existing firm earns Rs. 18,000 on the capital of Rs. 150,000 and the normal rate of return is 10%. The normal profits will work out at Rs. 15,000, 150,000 times 10 100ths. The super profits in this case will be Rs. 3,000, Rs. 18,000 to 15,000. The goodwill under the super profit method is ascertained by multiplying the super profits by certain number of years purchase. If, in the above example, it is expected that the benefit of super profits is likely to be available for 5 years in future, the goodwill will be valued at Rs. 15,000, 3,000 times 5. Thus, the steps involved under the method are: 1. Calculate the average profit. 2. Calculate the normal profit on the firm's capital on the basis of the normal rate of return. 3. Calculate the super profits by deducting normal profit from the average profits. And 4. Calculate goodwill by multiplying the super profits by the given number of years purchase. Rationalized 2023-24 admission of a partner 61. Illustration 12. The books of a business showed that the firm's capital employed on December 31, 2015, Rs. 500,000 and the profits for the last 5 years were 2010 Rs. 40,000 is to 2. 3. Capitalization method. Under this method, the goodwill can be calculated in two ways: a. By capitalizing the average profits, or b. By capitalizing the super profits. A. Capitalization of average profits. Under this method, the value of goodwill is ascertained by deducting the actual firm's capital in the business from the capitalized value of the average profits on the basis of normal rate of return. This involves the following steps. I. Ascertain the average profits based on the past few years' performance. E. Capitalize the average profits on the basis of the normal rate of return to ascertain the capitalized value of average profits as follows. Average profits 100, normal rate of return. E. Ascertain the actual firm's capital, net assets, by deducting outside liabilities from the total assets, excluding goodwill and fictitious assets. Firm's capital equals total assets, excluding goodwill, outside liabilities where outside liabilities include both long-term and short-term liabilities. IV. Compute the value of goodwill by deducting net assets from the capitalized value of average profits, i.e., E. Treatment of goodwill. As stated earlier, the incoming partner who acquires his share in the profits of the firm from the existing partners brings in additional amount to compensate them for loss of their share in super profits. It is termed as his share of goodwill, also called premium for goodwill. 3.5.5.1 When the new partner brings goodwill in cash. The amount of premium brought in by the new partner is shared by the existing partners in their ratio of sacrifice. If this amount is paid to the old partners directly, privately, by the new partner, no entry is passed in the books of the firm. But, when the amount is paid through the firm, which is generally the case, the following journal entries are passed. I. Bank A, C Drive. To premium for goodwill A, C, amount brought by new partner as premium, E, goodwill A, C Drive. To sacrificing partners capital A, C, individually, goodwill distributed among the existing partners in their sacrificing ratio. Alternatively, it is credited to the new partner's capital account and then adjusted in favor of the existing partners in their sacrificing ratio. In that case, the journal entries will be as follows. Rationalized 2023-24 admission of a partner 65. I. Bank A, C Drive. To new partners capital A, C, amount brought by new partner for his share of goodwill. E. New partners capital A, C Drive. To sacrificing partners capital A, C's, individually, goodwill brought by new partners distributed among the existing partners in their sacrificing ratio. If the partners decide that the amount of premium for goodwill credited to their capital accounts should be retained in business, an additional entry is not passed. If, however, they decide to withdraw their amounts, in full or in part, the following additional entry will be passed. Existing partners capital A, C, individually, Drive. To Bank A, C, the amount of goodwill withdrawn by the existing partners. Illustration. Hence the new partner does not bring goodwill in cash. Partly or fully goodwill not brought by the new partner will be debited to current account of new partner, while sacrificing partners' capital accounts will be credited for their respective shares. When the new partner does not bring the share of goodwill, there exists two possibilities. A. Goodwill does not exist in the books. And B. Goodwill exists in the books. Goodwill does not exist in the books. When goodwill does not exist in the books, sacrificing partners are credited with their share of goodwill and new partner is debited by the amount of goodwill not brought by him. The journal entry in this case is, incoming, new, partners current A, C Drive. To sacrificing partners capital A, C, individually, account of goodwill not brought in by new partner. Sometimes the new partner brings part of premium for goodwill in cash. In such a situation, new partner's current account will be debited by the amount not brought by new partner. Rationalized 2023-24, 7O Accountancy, Not-for-Profit Organization and Partnership Accounts. For example, for the share of goodwill of Rs. 50,000 the new partner brings Rs. 20,000 only. In this situation the journal entry will be I. Bank A, C Dr. 20,000 to premium for. Hence goodwill exists in the books. Goodwill appearing in the books will be written off by debiting old partners' capital accounts in their old profit sharing ratio. Thereafter new value of goodwill will be given effect by crediting sacrificing partners' capital accounts and debiting new partners' current account. Rationalized 2023-24 admission of a partner 71. The journal entries will be as under. I. When the value of goodwill appears in the books and is written off partners capital A, C, old, Dr, in profit sharing ratio, to goodwill A, C, goodwill appearing in the books written off. E. For new value of goodwill, incoming partners current A, C. Dr. To sacrificing partners capital A, C. In sacrificing ratio, individually. Illustration 20 Ram and Rahim are partners in a firm sharing profit. of Accounting Standard. Bank A, C. Doc. PP Applicability of Accounting Standard 26. Intangible assets. The standard comes into effect in respect of expenditure incurred on intangible items during the accounting periods commencing on or after April 1, 2003. As per the standard, intangible asset under AS 26 is defined as an identifiable, non-monetary, without physical existence and held for use in the production or supply of goods or services for rental to others or for administrative purposes. Significant requirements of AS 26W are T. Intangible assets. 1. Intangible asset should be recognized by fulfilling the criteria as recognized under AS 26. 2. If an asset does not satisfy recognition criteria, it should be expensed. 3. Internally generated goodwill should not be recognized as an asset. 4. Internally generated brands, mastheads, and publishing titles and other similar in substance should not be recognized as intangible assets. 5. Internally generated assets other than the goodwill, brands, mastheads, and publishing titles may be recognized provided they satisfy recognition criteria as prescribed by AS 26. 6. Intangible assets should be written off as early as possible but not exceeding its estimated life, which normally should not be beyond 10 years. Rationalized 2023-24 Admission of a Partner 73. Accounting Standard 26 implies that a purchased goodwill may be accounted for in the books and shown as an asset. Where it is accounted for in the books and shown as assets, it should be written off as early as possible. But where it is to be written off in more than one accounting year, it should be written off in a period not exceeding 10 years. In line with what is prescribed by the accounting standard, goodwill appearing in the balance sheet is written off at the time of firm's reconstitution. B. Self-generated goodwill is not accounted for in the books and shown as an asset. Thus, if self-generated goodwill be debited to goodwill account, it should be written off in the same financial year and should not be shown as an asset in the balance sheet. Alternatively, value of goodwill may be adjusted by deducting new partners' current account and crediting in their sacrificing ratio. The effect under both the methods is same. Test your understanding. 2. Choose the correct alternative. 1. At the time of admission of a new partner, general reserve appearing in the old balance sheet is transferred to a. All partners' capital account, b. New partners' capital account, c. Old partners' capital account, d. None of the above. 2. Asha and Nisha are partners sharing profit in the ratio of 2:1. Asha's son Ashish was admitted for 1/4 share, of which 1/8 was gifted by Asha to her son. The remaining was contributed by Nisha. Goodwill of the firm invalued at Rs. 40,000. How much? Hidden goodwill. Sometimes the value of goodwill is not given at the time of admission of a new partner. In such a situation, it has to be inferred from the arrangement of the capital and profit sharing ratio. Suppose A and B are partners sharing profits equally with capitals of Rs. 45,000 each. They admitted C as a new partner for 1/3 share in the profit. C brings in Rs. 60,000 as his capital. Based on the amount brought in by C and his share in profit, the total Rs. 150,000, which is to be shared equally, old ratio, by A and B. This shall raise their capital accounts to Rs. 60,000 each and total capital of the firm to Rs. 180,000. In this, C's current account will be debited by Rs. 10,000, his share of goodwill, and A and B's capital accounts credited by Rs. 5,000 each. Illustration 22. Haim and Nem are partners in a firm sharing profits in the ratio of 3:2. Their capitals were Rs. 80,000 and Rs. Adjustment for accumulated profits and losses. Sometimes a firm may have accumulated profits not yet transferred to capital accounts of the partners. These are usually in the form of general reserve and/or profit and loss account. The new partner is not entitled to have any share in such accumulated profits. These are distributed among the partners by transferring it to their capital current accounts in old profit sharing ratio. Similarly, if there are some accumulated losses in the form of a debit balance of profit and loss account and/or deferred revenue expenditure appearing in the balance sheet of the firm, it should be transferred to the old partner's capital accounts. See illustration 23. Rationalized 2023-24 admission of a partner 77. Illustration 23. Revaluation of assets and reassessment of liabilities. At the time of admission of a new partner, it is always desirable to ascertain whether the assets of the firm are shown in books at their current values. In case the assets are overstated or understated, these are revalued. Similarly, a reassessment of the liabilities is also done so that these are brought in the books at their correct values. At times there may also be some unrecorded assets and liabilities of the firm. These also have to be brought into the books of the firm. For this purpose, the firm has to prepare the revaluation account. The gain or loss on revaluation of each asset and liability is transferred to this account, and finally its balance is transferred to the capital accounts of the old partners in their old profit sharing ratio. In other words, the revaluation. Rationalized 2023-24-78 accountancy, not-for-profit organization and partnership accounts. Account is credited with increase in the value of each asset and decrease in its liabilities because it is a gain, and is debited with decrease in the value of assets and increase in its liabilities as debited to revaluation account because it is a loss. Similarly, unrecorded assets are credited and unrecorded liabilities are debited to the revaluation account. If the revaluation account finally shows a credit balance, then it indicates net gain, and if there is a debit balance, then it indicates net loss, which will be transferred to the capital accounts of the old partners in old ratio. The journal entries recorded for revaluation of assets and reassessment of liabilities are as follows. I. For increase in the value of an asset A, C drive. To revaluation A, C, gain. E. For reduction in the value of an asset revaluation A, C drive. To asset A, C, loss. E. For appreciation in the amount of a liability revaluation A, C drive. To liability A, C, loss. IV. For reduction in the amount of a liability A, C drive. To revaluation A, C, gain. V. For an unrecorded asset A, C drive. To revaluation A, C, gain. V. For an unrecorded liability revaluation A, C drive. To liability A, C, loss. V. For transfer of gain on revaluation if credit balance revaluation A, C drive. To old partners capital A %2, old ratio, individually. V. For transferring loss on revaluation old partners capital A %2 drive. Individually, old ratio, to revaluation A, C. Note, entries, I, E, and IV, are recorded only with the amount increase and decrease in the value of assets and liabilities. Rationalized 2023-24 admission of a partner 79. Illustration 24. Following is balance sheet of A and B who share profits in the ratio of 3:2. Balance sheet of A and B as on April 1, 2015. Liabilities amount, assets amount. Rs. Sundry creditors 20,000 cash in hand 3,000 capsules debtors 12,000 A 30,000 stock 15,000 B 20,000 50,000 furniture 10,000 plant and machinery 30,000 70,000 70,000. On that date C is admitted into the partnership on the following terms. 1. C is to bring in Rs. 15,000 as capital and Rs. 5,000 as premium for goodwill for 1/6 share. 2. The value of stock is reduced by 10% while plant and machinery is appreciated by 10%. 3. Furniture is revalued at Rs. 9,000. 4. A provision for doubtful debts is to be created on sundry debtors at 5% and Rs. 200 is to be provided for an electricity bill. 5. Investment worth Rs. 1,000, not mentioned in the balance sheet, is to be taken into account. 6. A creditor of Rs. 100 is not likely to claim his money and is to be written off. Record journal entries and prepare revaluation account and capital account of partners. Solution. Books of A, B and C journal. Date particulars LF debit credit 2015 amount. Rs. April Bank A, C Dr. 20,000 01 to C's capital account 15,000 to goodwill A, C 5,000, cash brought in by C as capital and goodwill, premium. Rationalized 2023-24-80 accountancy, not-for-profit organization and partnership accounts. O2 goodwill A, C drive 5,000 to A's capital A, C 3,000 to B's capital A, C 2,000, premium divided between A and B in sacrificing ratio 3. 2. O3 revaluation A, C drive 3,100 to stock A, C 1,500 to furniture 1,000 to provision for doubtful debt A, C 600, revaluation in the value of assets on revaluation, O4 plant and machinery A, C drive 3,000 investment A, C 1,000 to revaluation A, C 4,000, increase in the value of assets on revaluation, O5 revaluation A, C drive 200 to outstanding electricity A, C 200 amount provided for outstanding electricity bill, O6 sundry creditors A, C drive 100 to revaluation A, C 100 amount not likely to be claimed by the creditors written off, O7 revaluation A, C drive 800 to A's capital A, C 480 to B's capital A, C 320, profit on revaluation of assets and reassessment of liabilities transferred to A and B in old profit sharing ratio. Revaluation account. Drive CR. Particulars amount. Rs. Stock 1,500 plant and machinery 3,000 furniture 1,000 investments 1,000 provision for doubtful 600 sundry creditors 100 outstanding electricity 200 profit on revaluation transferred to A's capital 480 B's capital 320 4,100 Rationalized 2023-24 admission of a partner 81. Partners capital accounts. Drive CR. Date particulars ABC 2017 Rs. 2017 Rs. April. 01 balance 33,480 22,320 15,000 April. 1 balance sub, D 30,000 20,000 C, D bank 15,000. Goodwill 3,000 2,000 revaluation 480,000 320, profit. 33,480 22, 32015, 000 33,480 22,320 15,000. Illustration 25. Given below is the balance sheet of A and B, who are carrying on partnership business as on March 31, 2017. A and B share profits in the ratio of 2:1. Balance sheet of A and B as at March 31, 2017. Liabilities amount, assets amount. As. Bills payable 10,000, cash in hand 10,000, sundry creditors 58,000, cast at bank 40,000, outstanding expenses 2,000, sundry debtors 60,000, capital stock 40,000, A 180,000, plant and machinery 100,000, B 150,000, 330,000, building 150,000, 400,000. C is admitted as a partner on the date of the balance sheet on the following terms. 1. C will bring in 1 rupee, 00000 as his capital and 60,000 rupees as his share of goodwill for 1/4 share in profits. 2. Plant is to be appreciated to 120,000 rupees and the value of buildings is to be appreciated by 10%. 3. Stock is found overvalued by 4,000 rupees. 4. A provision for doubtful debts is to be created at 5% of debtors. 5. Creditors were unrecorded to the extent of 1,000 rupees. Record revaluation account, partners' capital accounts, and the balance sheet of the constituted firm after admission of the new partner. Rationalized 2023-24-82 accountancy, not-for-profit organization and partnership accounts. Solution. Books of A and B revaluation account. Drive CR. Particulars amount. As. Stock in hand 4,000, plant and machinery 20,000, provision for doubtful debts 3,000, buildings 15,000, creditors profit on revaluation 1,000, transferred to A's capital 18,000, B's capital 9,000, 27,000, 35,000. Partners' capital accounts. Drive CR. Date particulars ABC. Date particulars ABC 2017 As 2017 as March balance 238,179,000 100,000 March balapche B D 180,000 150,000 31 C D 31 bank 100,000 goodwill 40,000 20,000 revaluation 18,000 9,000 238,000 179,000 100,000 238,000 179,000 100,000 Balance sheet of A, B and C as on April 1, 2016. Liabilities amount, assets amount. As bills payable 10,000, cash in hand 10,000, sundry creditors 59,000, cash at bank 200,000, outstanding expenses 2,000, sundry debtors 60,000, capitals less provision for 3,000 57,000, A 238,000, doubtful debts B 179,000, stock 36,000, C 100,000 517,000, plant and machinery 120,000. Buildings 165,000 588,000 588,000. Rationalized 2023-24 admission of a partner 83. Do it yourself. 1. Aslam, Jacob, Hari are equal partners with capitals of Rs 1,500, Rs 1,750 and Rs 2,000 respectively. They agree to admit Satnam into equal partnership upon payment in cash of Rs 1,500 for 1/4 share of the goodwill and Rs 1,800 as his capital, both sums to remain in the business. The liabilities of the old firm amount Rs 3,000 and the assets, apart from cash, consist of motors Rs 1,200, furniture Rs 400, stock Rs 2,650, debtors of Rs 3,780. The motors and furniture were revalued at Rs 950 and Rs. 380 respectively, and the depreciation written off. Ascertain cash in hand and prepare the balance sheet of the firm after Satnam's admission. 2. Benu and Sunil are partners sharing profits in the ratio of 3:2 on April 1, 2017. Ina was admitted for 1/4 share who paid Rs. 200,000 as capital and Rs. 100,000 for premium for goodwill in cash. At the time of admission, general reserve amounting to Rs. 120,000 and profit and loss account amounting to Rs. 60,000 appeared on the liability side of the balance sheet. Required, record necessary journal entries to record the above transactions. 3. Ashu and Rahul are partners sharing profits in the ratio of 5:3. Gaurav was admitted for 1/5 share and was asked to contribute proportionate capital and Rs. 4,000 for premium, goodwill. The capitals of Ashu and Rahul, after all adjustments relating to revaluation, goodwill etc., worked out to be Rs. 45,000 and Rs. 35,000 respectively. Required, calculate new profit sharing ratio, capital to be brought in by Gaurav and record necessary journal entries for the same. 2.8 Adjustment of capitals. Sometimes, at the time of admission, the partners agree that their capitals should also be adjusted so as to be proportionate to their profit sharing ratio. In such a situation, if the capital of the new partner is given, the same can be used as a base for calculating the new capitals of the old partners. The capitals thus ascertained should be compared with their old capitals after all adjustments relating to goodwill reserves and revaluation of assets and liabilities, etc., have been made. And then the partner whose capital falls short will bring in the necessary amount to cover the shortage, and the partner who has a surplus will withdraw the excess amount of capital. See illustration 26. Illustration 26. A and B are partners sharing profits in the ratio of 2:1. C is admitted into the firm for 1/4 share of profits. C brings in Rs. 20,000 in respect of his capital. The capitals of old partners A and B, after all adjustments relating to goodwill, revaluation of assets and liabilities, etc., are Rs. 45,000 and Rs. 15,000 respectively. It is agreed that partners' capitals should be according to the new profit sharing ratio. Rationalized 2023-24-84 Accountancy, not-for-profit organization and partnership accounts. Determine the new capitals of A and B and record the necessary journal entries, assuming that the partner whose capital falls short brings in the amount of deficiency and the partner who has an excess withdraws the excess amount. Solution. 1. Calculation of new profit sharing ratio. Assuming the new partner C acquires his share from A and B in their old profit sharing ratio, i.e. A 2:1. Total share equals 1. C's share 1. 4 remaining shares equals 13144. A's new share equals 32.6. 4312. B's new share equals 31.3. 4312. C's new share equals 13.3. 4312. Thus, new profit sharing ratio between A, B and C is 6:3, 3:2, 1:1. 2. Required capital of A and B. C's capital, who has 1/4 share in profits, is Rs. 20,000. B's new share in profits 1/4. Hence his capital will also be Rs. 20,000. A's new share is 2/4, which is double of C's share. Hence his capital will be Rs. 40,000. Alternatively, based on C's capital, the total capital of the firm works out at Rs. 80,000, 4/1 times Rs. 20,000. Hence, based on their share in profits, the capital of A and B will be A's capital equals 2/4 of 80,000 equals R's. 40,000 B's capital equals 1/4 of 80,000 equals R's. 20,000 the capital of A and B after all adjustments have been made are R's. 45,000 and R's. 15,000 respectively. Hence, A will withdraw R's. 5,000 R's. 45,000 R's. 40,000 from the firm, whereas B will contribute additional amount of R's. 5,000 R's. 20,000 R's. 15,000. The journal entries will be date particulars LF debit credit. Amount R's. R's. A's capital A, C Dr. 5,000 to cash A, C 5,000, excess capital withdrawn by A. Rationalized 2023-24 admission of a partner 85. Cash A, C Dr. 5,000 to B's capital A, C 5,000, deficiency made good by additional amount brought in by B. Sometimes, the total capital of the firm may clearly be specified, and it is agreed that the capital of each partner should be proportionate to his share in profits. In such a situation, each partner's capital, including the new partner's capital to be brought by him, is calculated on the basis of his share in profits. By bringing in additional amount or withdrawal of excess amount, the final capital of each partner can be brought up to the required level. It may be noted that subject to agreement among the partners, surplus or deficiency in each old partner's capital accounts can also be taken care of simply by transfer to their respective current accounts. See Illustration 27. Illustration 27. A, B and C are partners in a firm sharing profits. The ratio of 3:2:1. D is admitted into the firm for 1/4 share in profits, which he gets as 1/8 from A and 1/8 from B. The total capital of the firm is agreed upon as R's. 120,000, and D is to bring in cash equivalent to 1/4 of this amount as his capital. The capitals of other partners are also to be adjusted in the ratio of their respective shares in profits. The capitals of A, B and C after all adjustments are R's. 40,000, R's. 35,000 and R's. 30,000 respectively. Calculate the new capitals of A, B and C, and record the necessary journal entries. Solution. 1. Calculation of new profit sharing ratio, A equals 1,1,3,2,8,8. B equals 1,1,5,3,8,2,4. C will continue to get 1/6 as his share in the profits. Thus, the new profit sharing ratio between A, B, C and D will be 3:5:1:1:9:5:4:6 or 8:2:4:6:4:2:4:2:4:2:4 or 9:5, 4:6. 2. Required capitals of all partners. A's capital equals R's. 120,924 equals R's. 45,000 B's capital equals R's. 120,524 equals R's. 25,000. Rationalized 2023-24-86 accountancy, not-for-profit organization and partnership accounts. C's capital equals R's. 120,424 equals R's. 20,000 D's capital equals R's. 120,624 equals R's. 30,000. Hence, A will bring in R's. 5,000 R's. 45,000 R's. 40,000 B will withdraw R's. 10,000 R's. 35,000 R's. 25,000 C will withdraw R's. 10,000 R's. 30,000 Rs, 20,000, and D will bring in Rs. 30,000. Alternatively, the current accounts can be opened and the amounts to be brought in or withdrawn by A, B and C will be transferred to their respective current accounts subject to the agreement among the partners. The journal entries in this regard will be recorded as follows. Books of A, B, C and D journal. Date particulars LF debit credit. Amount Rs. Cash A, C Dr. 5,000 to A's capital A, C 5,000, deficiency made good by additional amount brought in by A, B's capital A, C drive. C's capital A, C Dr. 10,000 to cash A, C 10,000, excess amounts withdrawn by B and C, 20,000 cash A, C Dr. 30,000 to D's capital A, C 30,000, cash brought in by D as capital. Alternatively, for entries 2 and 3 above shall be books of A, B, C and D journal. Date particulars LF debit credit. Amount Rs. A's current A, C Dr. 5,000 to A's capital A, C 5,000, deficiency in A's capital transferred to A's current account, B's capital A, C Dr. 10,000 C's capital A, C Dr. 10,000 to B's current A, C 10,000 to C's current A, C 10,000, excess capital of B transferred to their current account. Rationalized 2023-24 admission of a partner 87. Illustration 28. A and B are partners in a firm sharing profits in the ratio 2:1. C is admitted into the firm with 1/4 share in profits. He will bring in Rs. 30,000 as capital and capitals of A and B are to be adjusted in the profit sharing ratio. The balance sheet of A and B as on March 31, 2017, before C's admission, was as under. Balance sheet of A and B as at March 31, 2017. Liabilities amount, assets amount. Rs. Creditors 8,000 cash in hand, 2,000 bills payable, 4,000 cash at bank, 10,000 general reserve, 6,000 sundry debtors, 8,000 capitals, A 50,000 stock, 10,000 B 32,000,82. 000 furniture 5,000. Machinery 25,000, building 40,000, 100,000, 100,000. Other terms of agreement are as under. 1. C will bring in Rs. 12,000 as his share of goodwill. 2. Building was valued at Rs. 45,000 and machinery at Rs. 23,000. 3. A provision for bad debts is to be created at 6% on debtors. 4. The capital accounts of A and B are to be adjusted by opening current accounts. Record necessary journal entries, show necessary ledger accounts and prepare funds balance sheet after C's admission. Books of A, B and C journal. Date particulars LF debit credit 2017 amount. Rs. March 1 cash A, C Dr. 42,000 to C's capital A, C 30,000 to goodwill A, C 12,000, amounts of capital and goodwill brought in by C, goodwill A, C Dr. 12,000 to A's capital A, C 8,000 to B's capital A, C 4,000, goodwill brought in by C transferred to A and B in their ratio of sacrifice, revaluation A, C Dr. 2,480 to machinery A, C 2,000 to provision for bad debts A, C 480, decrease in the value of machinery and creation of provision for bad debts. Rationalized 2023-24-88 accountancy, not-for-profit organization and partnership accounts. Building A, C drive 5,000 to revaluation A, C 5,000, increase in the value of building, revaluation A, C drive 2,520 to A's capital A, C 1,680 to B's capital A, C 840, Profit on revaluation distributed between A and B. General Reserve A, C drive 6000 to A's capital A, C 4000 to B's capital A, C 2000, undistributed profit transferred to A and B, A's capital A, C drive 3680 to A's current A, C 3680, the excess of capital transferred to partner's current account, B's capital A, C drive 8.840 to B's current A, C 8840, the excess of B's capital transferred to partner's current account. Revaluation account. Drive CR. Particulars amount. Rs. Machinery 2000, building 5000, provision for bad debts 480, transfer of profit on revaluation to A's capital 1680, B's capital 842,520. 5000. Partners capital accounts. Drive CR. Date particulars ABC. Date particulars ABC. Rs. Current accounts 3,688,840, balance B. D 50,000 32,000, balance C. D 60,000 30,000 30,000, cash 30,000. Goodwill 8,000 4,000, general reserve 4,000 2,000, revaluation 1,680 840, transfer of profit 63,680 38,840 30,000, 63,680 38,840 30,000. Rationalized 2023-24 admission of a partner 89. Partners current accounts. Drive CR. Date Hange in profit sharing ratio among the existing partners. Sometimes, the partners of a firm decide to change their existing profit sharing ratio without any admission or retirement of a partner. This results in a gain of additional share in future profits of the firm for some partners while a loss of a part thereof for other partners. For example, A, B and C are partners in a firm. Rationalized 2023-24-94 accountancy, not-for-profit organization and partnership accounts. Sharing profits in the ratios of 8:5:3, it is felt that A will no more be able to actively participate in the affairs of the firm. Hence, with effect from April 1, 2007, they decided that, in future they will share the profits in the ratio of 5:6:5. This results in a losing 3:1:6:8:5. 16:16. AOC divided by C divided by C divided by AO share in profits while 5:1:6:1:6. AOC divided by C divided by C divided by AO and 2:1:6:5:3:1:6:1:6. AOC divided by C divided by C divided by AO. In such a situation, the loss and gain in the value of goodwill, if any, will have to be adjusted. This is done by crediting sacrificing partners and debiting gaining partners with appropriate amounts, as is explained earlier in the context of the admission of a new partners. Any change in the profit-sharing ratio, like admission of partner, may also involve adjustments in respect of revaluation of assets and liabilities, transfer of accumulated profit and losses to partners' capital accounts in the old profit-sharing ratio and adjustment of partners' capitals, if specified, so as to make them proportionate to the new profit-sharing ratio. All this is done in the same way as in case of admission of a partner. Terms introduced in the chapter. 1. Reconstitution of partnership firm. 2. Revaluation of assets. 3. Reassessment of liabilities. 4. Undistributed and accumulated profits and losses. 5. Accumulated losses. 6. Goodwill. 7. Profit sharing ratio. 8. Reserves. 9. Revaluation account. 10. Sacrificing ratio. 11. Change in profit sharing ratio. Summary. 1. Matters requiring adjustments at the time of admission of a partner. Various matters which need adjustments in the books of firm at the time of admission of a new partner are goodwill, revaluation of assets and liabilities, reserves and other accumulated profits and losses, and the capitals of the old partners, if agreed. 2. Determining the new profit sharing ratio and calculating sacrificing ratio. The new partner acquires his share in profits from the old partners. This reduces the old partner's share in profits. Hence, the problem of determining the new profit sharing ratio simply involves the determination of old partner's new share in the profits of the reconstituted firm. Given the new partner's share in profits and the ratio, in which he acquires it from the old partners, the new share of each old partner shall be worked out by deducting his share of sacrifice from his old share in profits. The ratio in which the old partners have agreed to sacrifice their shares in profit in favor of the new partner is called the sacrificing ratio. It is usually same as the old profit sharing ratio. However, based on the agreement it can be different also. 3. Treatment of goodwill. Goodwill is an intangible asset and belongs to its owner at a point of time. On the admission of a new partner, the goodwill of the firm belongs to the old partners. It means that on the admission of a new partner, some adjustments must be made into the capital accounts of the old partners for goodwill so that the new partner will not acquire a share in that profit which the firm earns because of its goodwill earned before admission without making any payment for the same. The amount that the new partner pays for goodwill is called goodwill. From accounting point of view, the firm may have to face different situations for the treatment of goodwill at the time of admission of a partner. The amount of premium brought in by the new partner is shared by old partners in the ratio of sacrifice. In case the new partner fails to bring his rationalized 2023-24-98 accountancy, not-for-profit organization and partnership accounts, share of premium for goodwill in cash, then the capital account of the new partner is debited for his share of premium of goodwill and the old partner's capital accounts are credited in their sacrificing ratio. 4. Adjustments for revaluation of assets and reassessment of liabilities. If, at the time of admission of a partner, the assets and liabilities are revalued or some asset or liability is found unrecorded, necessary adjustments are made through the revaluation account. Any gain or loss arising from such exercise shall be distributed among the old partners in their old profit sharing ratio. 5. Adjustment for reserves and accumulated profits, losses. If, at the time of admission of a partner, any reserve and accumulated profits or losses exist in books of the firm, these should be transferred to old partners' capital, current accounts in their old profit sharing ratio. 6. Determining, adjusting partners' capital. If agreed, the partners' capital may be adjusted so as to be proportionate to their new profit sharing ratio. In that case, the new partner's capital is normally used as a base for determining the new capitals of the old partners and necessary adjustment made through case or by transfer to partners' current accounts. Other bases also may be available for determining capitals of the partners after admission of the new partner, like sharing the total capital to be in the firm immediately after admission of the new partner. 7. Change in profit sharing ratio. Sometimes the partners of a firm may agree to change their existing profit sharing ratio. With the result, some partners will gain in future profits while others will lose. In such a situation, the partner who gain by change in profit affecting amounts to one partner buying the share of profit from another partner. Apart from the payment for compensation, the change in profit sharing ratio also necessitates adjustment in partners' capital accounts with respect to undistributed profits and reserves, revaluation of assets and reassessment of liabilities. Questions for practice. Short answer questions. 1. Identify various matters that need adjustments at the time of admission of a new partner. 2. Why it is necessary to ascertain new profit-sharing ratio even for old partners when a new partner is admitted. 3. What is sacrificing ratio? Why is it calculated? 4. On what occasions sacrificing ratio is used? 5. If some goodwill already exists in the books and the new partner brings in his share of goodwill in cash, how will you deal with existing amount of goodwill? 6. Why there is need for the revaluation of assets and liabilities on the admission of a partner? Rationalized 2023-24 admission of a partner 99. Long answer questions. 1. Do you advise that assets and liabilities must be revalued at the time of admission of a partner? If so, why? Also describe how is this treated in the book of account? 2. What is goodwill? What factors affect goodwill? 3. Explain various methods of valuation of goodwill. 4. If it is agreed that the capital of all the partners should be proportionate to the new profit-sharing ratio, how will you work out the new capital of each partner? Give examples and state how necessary adjustments will be made. 5. Explain how